What to expect from the Fed next week and the market implications.
At least in June, the probability is pretty low. I think they are going to pause. We're not going to misinterpret that as a dovish pivot. They're not going to want to get easing priced in. So it's nothing like that. But the Fed's probably not moving this meeting.
Until we got a debt ceiling deal, we were going to have plenty of liquidity in the system. But once that debt deal got done, then we were going to have what I'm calling liquidity, another extreme liquidity climate change storm.
The government has avoided default, but the effects of the debt ceiling brinkmanship may still ripple across the economy. Are you curious about what uncertainties are hovering around the US economy and market in 2023? And what will be the Fed's next move? Well, to answer all of these questions, in today's video, Lyn Alden has shared her viewpoint of the current situation of the economy. To know more details, stay tuned until the end of this video. And if you want to stay up to date with the latest crypto insights, the markets, and the economy, be sure to hit that subscribe button and the bell icon. Okay, are you ready? Let's get into it.
The debt ceiling has been something I've been following ever since they technically ran into the debt ceiling back in January, right? So we've actually been in this period of multi-month period of the Treasury doing extraordinary measures to, manage their cash. And so back then, my key theme was that liquidity is actually probably going to be pretty good for the next several months because the Treasury was forced to basically push their cash into the market because they had to spend down their cash balance in order to keep paying their bills because they couldn't finance it with new debt and they didn't, and their taxes don't cover it. And so for the for pretty much the first half of this year, the debt ceiling has ironically probably been constructive for markets because the Federal Reserve has been tightening this whole time and the Treasury's basically been forced to offset that. So you've had a neutral liquidity environment. So I was like, a lot of things are probably going to go sideways. Some things could go up. And so I wasn't too concerned with markets in general. So it was a, somewhat bullish thing. But the point that I've been, kind of concerned about for a while is that when the debt ceiling is actually resolved, ironically, the liquidity environment could change. And of course, this is based on what a handful of policymakers decide to do, but it's something we have to navigate.
The US narrowly avoided a default when President Biden signed legislation on Saturday that allowed the Treasury Department, which was perilously close to running out of cash, permission to borrow more money to pay the nation's bills. Now, the Treasury is starting to build up its reserves, and the coming borrowing binge could present complications that rattle the economy. The Treasury has been using some tricks to keep paying its bills without borrowing more money, but that also meant that it had to spend its cash stash and pump it into the market. That was actually good for the markets in the first half of this year. It balanced out the Fed tightening moves and kept liquidity steady, so Lyn was mildly optimistic. But there is a catch. Once this debt ceiling is fixed, the liquidity situation could change. It's a tricky situation that we have to watch very closely because it could affect how much money is flowing in the market.
What I'm kind of focused on is what happens after the debt ceiling, because if they do successfully raise it, the Treasury's already depleted their cash balance. They're nearly at zero. They don't really have any spare cash anymore, and so they have to go back to the debt market like they normally used to and issue more bonds in order to keep paying their bills. And they also want to refill their cash balance back up to their $500 billion target, which basically means pulling liquidity out of the market, kind of like what the Fed's doing. And so the challenge there is if they do that too quickly, or they do it with a lot of longer duration bonds, they risk pulling that liquidity out of the banking sector. And they risk causing another round of bank liquidity problems, failures, messy Treasury auctions, messy Treasury market, illiquid Treasury market in general. I think that's kind of the key risk. And also just negative liquidity environments are bad for most risk assets most of the time, or at least it's one of the big variables that affects kind of the multi-month performance of major asset classes. So part of the reason why the first half of 2022 was so bad for most asset prices was that liquidity was constantly going down because the Fed was no longer adding liquidity to the market, and back then the Treasury was refilling its cash account from roughly zero after the prior debt ceiling issue. And so that was a particularly bad combination for liquidity, and we could repeat that again, but it's going to come down to what a handful of policymakers decide to do. How quickly do they want to fill that? What duration do they want to fill that? Are they going to be able to pull it out of reverse repos, which would be somewhat liquidity neutral, or are they going to end up kind of messing it up and pulling it out of banks and causing a round of problems?
The debt ceiling drama isn't over yet. Lyn Alden warns us about what could happen next. Now the debt ceiling is raised, the Treasury will have almost no cash left. That means that they'll have to suck money out of the market, just like the Fed is doing. But how will they do it? That's the tricky part. If they do it too fast or too long, they could dry up the bank's cash and cause another liquidity crisis. Banks could fail and treasury auctions could go haywire. And that would be bad news for most assets, which tend to suffer when liquidity is low. We saw that happen in the first half of 2022. Some analysts believe that the Fed could think of taking a pause from hiking rates when they meet next week in order to assess how the policy has so far impacted the economy. But the Treasury's cash refill could spoil their plans because it would make borrowing more expensive anyway. That could make things worse for investors and depositors who are already worried about how higher rates have hurt the value of their assets at smaller banks. What will the government do? Keep the market stable or mess it up? Let's hope that they make the right choices.
You could also see kind of forced QE while still trying to hold rates tight. One of the dynamics that we saw back in 2019 was the repo spike. And back then, you basically had a flood of T-bills come to market, and there wasn't really a lot of excess bank reserves to kind of pull that out. And so you started to get dysfunctions between bank lending. And so the Federal Reserve had to abruptly stop their quantitative tightening and go to doing quantitative easing, although they didn't want to call it that because they were only doing with T-bills, and they were only doing it for financial stability rather than as an intended form of stimulus. So the reasons for it and the specifics were a little bit different, but basically they kind of lost control of their balance sheet temporarily due to actions by just overall liquidity and treasury decisions. This one would be a little bit different because it's not that there's too many T-bills, it's that there might be too many T notes and T bonds relative to cash to absorb it, relative to the money wants to stay in money markets, and so I think you could see a similar dynamic. It's also kind of what happened back in March with the first round of bank problems, is that the Fed didn't want to provide that liquidity, but they were kind of forced to temporarily. They had to open up this new facility and use a bunch of existing facilities to put at least temporary liquidity back into the market. And so you could see the Fed's hand forced if they were to break something seriously, like if the treasury market gets dysfunctional, if you have another round of bank failures, if some of those kind of key markets freeze up again.
Lyn Alden explains how back in 2019 the Federal Reserve had to step in and pump money into the system, even though they didn't call it quantitative easing. They were trying to calm the markets, not stimulate the economy. The reason for this mess was a mismatch between liquidity and treasury decisions that affected the Fed's balance sheet. Now fast forward to today, we have a different problem. Too many T-notes and T-bonds chasing too few dollars or money market funds. Lyn thinks that this could lead to another crisis like the one in March, when banks faced a liquidity crunch and the treasury market froze up. But what about you guys? Do you agree with Lyn Alden? Can we witness another crisis? What will be the Fed's next decision? Only time will tell, but one thing's for sure. The uncertainties in the economy and market are far from over. Let me know your thoughts in the comments section below. And of course, don't forget to subscribe to my channel for more updates on crypto and the economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and we'll see you next time. Adios.